All right, so let's jump into lesson 4 in module 2. So this is on understanding mortgages. And so in this lesson, what we're going to do is we're going to demystify mortgages overall. So if you've heard terms like FHA, conventional, ARMs, fixed, things like that, it might sound kind of complicated. And if that's the case, then you are not alone. Do not worry. By the end of this lesson, you'll understand the main mortgage types, their pros and cons, and which one actually might be the best for your situation. So I am Dr. Kevin Schuford, the property professor. Let's go ahead and jump into this. So your mortgage is probably the single most important financial decision that you will make in the home buying process. This is going to cost you tens of thousands, hundreds of thousands more likely, potentially millions of dollars. And that is a really big decision. So the type of mortgage that you choose is not only going to affect your monthly payments, but it can also affect your long-term wealth building. Ideally, when we purchase a home, we do want to try to build some wealth. And so your mortgage really is a vehicle for generational wealth building. So some loans have some more money up front in terms of costs, but that costs potentially more later. And so other people or other mortgage types are going to give you more stability, but they might have a higher down payment. And so knowing the differences between these is going to help you match which loan type is going to be the best for your lifestyle and your timeline, as well as your financial situation overall. So let's go ahead and dive into this. First up, let's talk about fixed rate mortgages. So this is exactly what it sounds like. Your interest rate is going to stay the same for the entire life of the loan, whether that's going to be a 15-year, 20-year, 30-year mortgage. There are also some 40-year mortgages now that are being floated, so kind of be on the lookout for that potentially. But the 30-year fixed mortgage is the traditional mortgage overall. And so the big advantage with a fixed mortgage is that you have predictability. And so your monthly principal and your interest amount is never going to change, even if the market rates skyrocket, or even if they decrease, you could then refinance and get a lower rate. But if they do go up, you're not actually going to have to pay more money. And so a fixed rate mortgage is ideal if you plan to stay in the home for long term, or you are someone or you're someone who values that stability. But the trade-off here is that sometimes with these fixed rate mortgages, that interest rate might be a little bit higher than adjustable rate mortgages. But once again, it gives you more stability and more security. Next up, let's talk about adjustable rate mortgages, or ARMs. These ones can be very beneficial for you potentially, but they also have some pretty big caveats. So oftentimes when the market interest rate is high, an ARM could be a good decision because it starts with a lower interest rate for a set period of time, usually 5, 7, or 10 years. And then after that period, the rate is going to adjust based on what the market is doing, what the market rate looks like. So for example, if you were to see something that said 5-1 ARM, a 5-1 ARM means that your interest rate is fixed for 5 years, and then it's going to adjust once per year after that. And so the upside here is that you save money early on, but the downside is that if you hold on to the loan for too long, your rate could rise. And so if you're going to pursue or think about going with an ARM, then it is best typically for people who know that they're going to either move or refinance before that adjustment period kicks in. Let's talk about FHA loans. An FHA loan is backed by the Federal Housing Administration. And so these loans are pretty popular with first-time home buyers because you can usually qualify with a lower credit score down in the 500s, even 580 typically is what you'll see there. And so you can qualify with a lower credit score and a down payment as little as 3.5%. You do not need 20% down payment to purchase a home. That's one of the myths that we talked about in Module 1, so go back and check that out because that is not true. So the unfortunate part here, the trade-off here, is that you're going to have what's called mortgage insurance. And so you're going to pay an extra monthly fee that's going to protect the lender. And so unless you put down at least 10%, this mortgage insurance is going to stay with you for the life of the loan. And so that's very important to note. So if you go with that 3.5% down, then you're going to be stuck with that mortgage insurance for the life of the loan. And so a way to get out of this is to refinance into a conventional loan, which we'll talk about here shortly. So that's one way to get rid of it. Or you could potentially your loan is also then assumable with FHA loans, and so someone can come in and take over your payment, and then you could go and buy a different house with the equity that you've built up. This is a little more complex. We can get into that later as well. So FHA is going to be perfect if you need an easier entry into home ownership, but it's not necessarily going to be the cheapest option long term unless you're going to get out and refinance into a different loan type. The conventional loan is next, and this is one of the most common types of mortgages. So here you can get into a home with as little as 3% down or 5% down typically, and you tend to qualify for these if you have stronger credit and stable income. So if you have a credit score of above about 620, that's ideal here to qualify for conventional, but the higher credit score that you have, the better rate you're going to get as well, up to a certain point, and then that's going to therefore impact your monthly mortgage payment. So the big advantage here, once again, is that you do not have to have that 20% down payment. But once you do reach that 20% payment or that 20% equity mark, you no longer have mortgage insurance. So with the FHA loan, that mortgage insurance is going to stay on for the life of the loan. But with conventional, once you reach 20% of equity, so say for example you put a 10% down payment, and then over time you have paid that loan down and your house is appreciated in value to where now you have a 20% loan to value ratio or 80% loan to value ratio, that would then allow that mortgage insurance to fall off, which could save you $100 to $250 potentially, depending on what your mortgage looks like. So the conventional loan is going to be great because it's going to give you more flexibility as well in terms of if you want to buy condos or second homes, investment properties. The conventional loan really is very versatile and has less restrictions than the FHA loan. And so it's good to think of the FHA loan as more of a starter loan and the conventional one as more of a long-term builder. So if you're just trying to get into the market, FHA is a pretty good way to go. But if you can qualify for a conventional, then that is typically what we'd recommend that you pursue. This one is for our veterans, the VA loans. So this is exclusively for veterans, active duty military, and eligible surviving spouses. And so if you qualify for a VA loan, this is one of the best deals out there by far. So it requires a 0 down payment. So with conventional, we said 3%. With FHA, we said 3.5%. This is a 0 down payment, right? That is crazy. There's also no mortgage insurance that is tied to this, which is going to help save on your monthly payment. And you typically have a lower interest rate, oftentimes by about 0.5%, which is really great. I mean, I love it. So the catch here, though, is the eligibility factor. It is only allowed, or it's only available to those who have served. But if you do qualify, it is almost always the smartest option. There are some restrictions and limitations, some income or some home value caps that exist, but those are, we can have a further conversation about that if you're interested in pursuing a VA loan. I highly, highly recommend. These loans are also assumable, similar to the FHA loan, so you can, if someone has a VA loan, you can then step in and assume their mortgage, take over their payments and their rate, but the veteran then would have to accept you stepping in to take it over because they would lose some of the value that they'd have in their VA loan entitlement. So it can get a little tricky, but if you are eligible for this, then I highly, highly recommend that you look into it. All right, so let's just put these side by side with this comparison chart here, just so you can see what the different terms are and how they differ overall. So fixed rate, once again, these loans are going to give stability, but oftentimes have a higher starting rate. And then you have the ARMs, which are the adjustable rate mortgages. These ones are going to give you the lower rate at first, but then it can rise later. So if you do an ARM, then you should try to make sure that you have a plan before that adjustment kicks in to make sure that you're not paying more overall. Next, you have FHA. These loans are easier to qualify for because they have lower credit limits. So in the 500s, about 580 ideally, potentially lower depending on who you're talking to and what your credit profile looks like, your financial profile looks like. But this is going to be great for first-time home buyers who need maybe a little bit more assistance. But the downfall here is that these loans do come with mortgage insurance that is hard to get rid of unless you refinance into a different type of loan. The conventional mortgage is going to be the one that offers you long-term flexibility, especially if you have stronger credit above 620. Higher is even better. This is going to allow you to purchase more homes, condos, investment properties, second homes with much more ease than an FHA loan would. And then finally, you have the VA loans. If you are eligible, this is the gold standard. It is unbeatable. You have a lower interest rate. You have a zero down payment. You have no mortgage insurance. It is such a great option if you qualify. So the key takeaway here is that you should be trying to match your loan type to your financial situation and how long you plan to stay in that home. And so if you're unsure about which one works best for you, then let's have a conversation and try to figure it out. Let's take a look at an example of what the different loan types are going to look like with a $400,000 home price. So with an FHA loan, you might put down 3.5%, which is going to be about $14,000. But that mortgage insurance, once again, is going to stay with you for the life of the loan. So that's going to add potentially a couple $100 to that monthly payment. With a conventional loan at 5% down, that would be $20,000 up front. But once that loan value hits the 80% mark or 20% equity, that mortgage insurance is going to fall off, and so you're actually going to be saving money every month. If instead you go with a 5/1 ARM instead of a fixed rate mortgage with either FHA or conventional, then you could save about $150 per month in the early years. But then once that fifth year kicks in, then that rate could adjust, and so you could end up actually paying more unless you refinance or sell before that adjustment period hits. So each path is going to have trade-offs, and so that's why planning is very important. There is no one size fits all. It really just depends on what your financial situation looks like and what your plans are for that home. Let's do a quick recap here. So fixed rate loans are going to be perfect for long-term stability, while ARMs or adjustable rate mortgages work best if you're planning shorter term ownership or expect to refinance before that adjustment hits. An FHA loan is going to help buyers with lower credit scores or smaller down payments amounts to get started, to get into the home, while conventional loans are going to reward those with stronger credit and offer with more flexibility and potentially lower long-term costs with that mortgage insurance that will fall off versus mortgage insurance staying on with the FHA loan. VA loans, once again, hands down the best options for those who qualify. 0% down payment, lower interest rate by about 0.5% from market rate, and no mortgage insurance either. So if you qualify, that's the one you want to go for. But remember, there is no one size fits all. It's, once again, the right choice depends on your timeline and your goals. Congratulations, you made it to the end of lesson 4. Next up, we are going to chat in lesson 5 about how seller credits and concessions work. This is one of the smartest, best ways to help save buyers money, especially in today's market. If it's a buyer's market, then this is a really great advantage. If it's a seller's market, I still recommend that you try to pursue these, but I will show you how some clients can cut their cash to close costs and potentially lower their monthly payments by hundreds of dollars. You're not going to want to miss out on this, so hit that subscribe button and we'll see you on the next one. A few things before you go. I would really appreciate it if you would like this video and also subscribe to the full Real Estate and Mortgage 101 series. Also, just for watching this, if you're interested in having the full Module 2, go ahead and click the link that's in the description down below and you'll get all of these resources for free. So you'll get this entire playback, you'll get the PowerPoint slides, and then in that I also have a lot more resources for you. It's my special treat for you just for watching, free of charge. I know that this can be a lot, but you can do it. I will help you walk through every step of the way. Thank you. Very quickly before you go, I just want to say thank you for taking time to listen to this lesson. I know that financing can be a tricky subject, so if you found it interesting or helpful, then please, I encourage you to like and subscribe. If you're interested in working with me, I am a licensed agent in California and Arizona, both a real estate agent and mortgage loan officer, but I do have referral partners across all 50 states and internationally. So feel free to text me, call me, email me, whatever works best for you. I'm here to help. Take care.